Do you want to pay more taxes or less? Now that's a real question when choosing your retirement account. So most people don't realize that the account type you pick today could decide how much money stays in your pocket tomorrow. Now let's break it down. First, we've got before tax accounts, IRA and 401k. So think of these like putting money away before Uncle Sam takes his share. In traditional IRA, you can put up to $7,000 in this account in 2025. So contributions are tax deductible today, meaning you pay less income tax this year. But here's a catch. You will pay taxes later when you withdraw during retirement. And once you turn 72, the government forces you to take money out. That's called required minimum distributions, or RMDs. Now 401k on the other hand, this is your employer sponsored cousin of traditional IRA. So in 2025, the contribution limit is $23,500, including IRA if you have one. The big benefit here is the employer matching. So basically free money if your company contributes. But again, withdrawals are taxed in retirement and you're stuck with RMDs at age 72. Now, on the other hand, you have the after-tax option, the Roth IRA. So here, you're contributing money that's already been taxed. Now, the benefit? Once it's in, the money grows tax-free. Withdrawals are tax-free, gains are also tax-free. The best of all, there's no RMDs. So you control when and how much money you want to take out. So now the big question is, which account should you choose? So it all depends on just one thing, tax rates now versus tax rates in the future. So here is the reality. There's overwhelming evidence that the taxes are going to go up. Now I want to back this claim by offering you two pieces of evidence. Now evidence number one is TCJA expiry. The Tax Cuts and Jobs Act from 2017 gave us historically low tax rates, but those are set to expire at the end of 2025. Now let's look at how tax brackets will change with the expiration of TCJA. 12% tax rate will go up to 15%. 22% becomes 25%. 24% jumps to 28% tax rate. 32% climbs to 33%. 37% raises to 39.6%. That's thousands more in taxes for the same income. Now let's put this in another perspective. At $100,000 income, you would pay about $4,000 more in taxes. At $200,000 income, you would pay about $8,500 more in taxes. And for $400,000, a whooping $23,000 more in taxes. Now evidence number two is America's fiscal gap. Simply put, the government spends way more than it collects in taxes. So just like a family cannot keep swiping their credit card forever, the government eventually has to balance their books. With millions of baby boomers retiring, Social Security, Medicare costs are exploding. Add to that defense spending, your infrastructure, and rising interest rate payment on national debt. The gap keeps widening. So what are the government options at this point? So government has only two options. One is to cut spending, which is obviously unpopular at this point, or raise taxes, which is the more likely path. So let's tie everything together with this one takeaway. If you expect tax rates to be lower in retirement, a traditional IRA or 401k could make sense. But if you strongly believe that the taxes will be higher in the future, and the evidence strongly suggests they will, a Roth IRA might be a smarter bet. At the end of the day, it's not just about saving money, it's about keeping it. Thank you so much for watching. If you like this video, please hit that like button and subscribe. With your subscription, more people will discover this video and learn from it too. And let me know in your comments which account type would you prefer and why. Perhaps there is someone out there who would read your comments and decide on their retirement strategy. Thank you so much for watching.